Welcome to the second Fillman Roll-Up and Associates Municipal Market Update. It's the week of May 4th, 2020. My name is Adam Bauer. I serve as CEO and President of Fillman Roll-Up and Associates. Fillman Roll-Up and Associates is a municipal advisor to government. The week of May 4th is an important week for America. We are a country that focuses on being open as much as we can. We open our retail stores on Thanksgiving. We open our movie theaters at midnight. And for a little more than a month, we've been encouraged to limit ourselves to just essential activities. But now we're getting to a point where many of the scientists and doctors say we can begin to look at reopening, but we don't know quite what that looks like yet. And we're all adapting. As we do that, there are a lot of thoughts and emotions that are baked into that, and we see that in the financial markets. And in particular, we do see that in the municipal market. So keep that in mind as a backdrop as we go through this, is that America has a great opportunity to go back and be something closer to what it is, but we're also dealing with something we've never dealt with before. On slide 2, we look at the AAA MMD again. AAA is the highest rating a governmental entity can achieve. MMD, municipal market data, yield curve, represents how interest rates are for each maturity from years 1 through 30. That red line is from 5 years ago, and that is what we call a traditional yield curve, where rates start off very low, but then they get pretty high at that 3% level for the 30-year. That tan line represents 1 year ago, and 1 year ago we had a very flat yield curve. That green line represents last Friday, and that line is just a bit steeper, and overall rates are a little bit higher than they were 1 week ago, and I'll get to the details of that. On slide 3, once again, we show the 5, 10, and 30-year MMD. Instead of going high-low on this, I'm just going to compare 2 weeks ago. 2 weeks ago, the 5-year was at 0.87, and now it's at 1.04. The 10-year was at 1.07, and now it's at 1.35. And the 30-year was at 1.90, and now it's at 2.16. So a modest shift upward, but I'm going to show you a little bit later, we are still at very low levels. Now the 10-year. One of the things I've talked to you about 2 weeks ago was that oftentimes municipals tend to track treasuries. But we're seeing that break down. We're not seeing that take place, and I'm going to explain that in a moment. But one thing I want to point out, 10-year treasury was at 0.65 2 weeks ago, 0.64. Almost the exact same. But the MMD has shifted upwards. That trend is definitely not here for the last 2 weeks. So why might that be? On this chart, what we're showing is, and I have not shown you this chart before, what we're showing is the credit spreads from the perfect credit. So AAA, perfect credit, as I described previously, but then just below that you have the AA, then you have single A, then you have the BAA. And so here, if you look at what yield, what additional yield do investors require for the AA? You can see pretty consistent over time, something in that 25, 30 basis point area. Then for a single A, you get a little more volatility, which you would expect a little bit further out on the credit curve. Then finally you get to BAA. And here's where investors come to and leave. So when they are risk on trade, they dive into the BAA. When it's a risk off trade, they are leaving the BAA. And if you go to the far right, what you can see is the change that we saw most recently from 3/6/2020 to 4/21/2020, a very large change in a very short period of time. We start off at 63 basis points spread, and we go up to 130, all in a month and a half. To get that type of change, let's go all the way to the far left. And what you hopefully see there is a pretty big spike. Well, what was taking place during that point in time? What was taking place was over the weekend, Bank of America bought Merrill Lynch. And Lehman, who didn't have a buyer, filed for bankruptcy on September 15, 2008. So in 2 days, two of the financial institutions that we've heard about for all of our lives were no longer in play, and one of them was no longer a viable entity going forward. So that led to investors fleeing lower rated credits and moving into higher rated credits. We have some real positive news. There has been the first CFD or Community Facilities District transaction in California completed since a lot of these stay-at-home orders were issued. And so that was unrated for a good portion of it. And hopefully that is a sign that you're going to see more types of credit come to the market. If you have any questions on that or want more details on that transaction, feel free to reach out to Jason Chung or myself. On slide 5, we show the inflows and outflows to the municipal market bond funds. Green, money flowing in; red, money flowing out. Generally, when there's green, that means there's more demand. Red means less demand. So more demand, rates should go down. Less demand, rates should go up. We saw mass outflows and kind of detailed that between 3.4 and 4.8, but then beginning on 4.15, money started flowing in. However, last week, we don't have the data available to us, but some of the trading desks have told us that money flowed out this last week. So another circumstance where there's a little bit less demand than there has been in other recent weeks. But having said that, we still are at very low levels. Once again, this is the municipal market data curve, the line with dots on it, and those bar charts represent the percentage of time each one of those maturities that had lower interest rates. So years 1 through 4, pretty low, but you've had plenty of other times with rates of that low, about 30% of the time there. But then you get out to years 8 through years 30. In years 8 through 30, less than 5% of the time have rates been as low as they are. Now, when I spoke with you 2 weeks ago, that number was below 3. So they've gone up from that, but not dramatically. So still a very low interest rate environment to be issuing municipal debt. So I've listed some of the economic indicators here, and these are certainly ones that everyone needs to monitor, especially 5/8/2020 when we look at the unemployment rate. But there is so much data out there that related to COVID-19 and what each governmental entity, how the states and the feds are going to interact together, that these aren't the only things that are going to be impacting the market going forward, but they certainly are important ones. So continue to monitor these. We'll continue to give you updates as we go through, but these are the ones that will take place over the next 2 weeks. Now, on this last page, we have the Film and Roll-Up and Associates Registered Municipal Advisors. I just want to take a minute to thank Michelle Seabrook. She has got us onto YouTube. When we sent this out, we had much more interest than we had ever expected. And so thank you, all of you, for showing that interest. But we also want to make it more accessible. So if you go to YouTube and you type in Film and Roll-Up and Associates, you should be able to access all our municipal market updates. And so thank you, Michelle. And not only have you been very helpful to all of us, but you've been very helpful to me. When we have something like this on YouTube, my son had said, "Dad, you're a YouTuber." And in his eyes, that's quite an accomplishment. Michelle, I could not have done that without you. Jason Chung, he is the expert that puts together all these graphs. And every other week, you're going to see some different graphs. We're going to try to illustrate points, keep this fresh. And Jason Chung is key behind that. Finally, someone that's not listed on here is Crystal Bennett. She is the one that pulls together all this and goes through every iteration with us. And she's shown a lot of patience, and just want to thank her too. Finally, one last person, Glenn McGowan of RBC. He was very helpful in talking a bit about the market and just allowing a conversation and help formulate our ideas for this week's presentation. So thank you all for your time. And I look forward to talking with you again on May 18th.